Thank you, David. Welcome this morning, and good morning to all of you, and welcome to the Federal Reserve Bank of Philadelphia. As David was alluding to, the Philadelphia Fed has had a long relationship with the Global Interdependence Center, and it's lasted for more than 30 years. We've participated in meetings with the GIC, both here and abroad, and with policy and leaders from around the world. We've benefited, the Fed has benefited from many good ideas and discussions at those meetings. And of course, that's why the Philly Fed today is proud to host today's event. Today's event, of course, is part 3 in this timely conference series on financial interdependence and the world's post-crisis capital markets. As you can see from the agenda, we'll hear perspectives from members of Congress, investment experts, and economists. And I'm particularly pleased that today's keynote speaker is my colleague from Boston, Eric Rosengren. We're delighted to have him with us as well. The financial crisis of the last 2 years will certainly alter the structure and performance of global capital markets in many, many ways. Competition and market forces will change many financial products and the way they are delivered. Financial products and innovations that fail the market test will disappear or they'll change. And that's how it should be. We should never underestimate the power of the market and its adaptability. Yet global financial markets will also be shaped, for better or worse, by the nature of financial regulatory reforms under consideration by lawmakers around the world. For example, recent discussions in Washington has centered on which regulatory agencies should have supervisory power over which types of institutions. One proposal would eliminate the Fed's oversight of state-chartered member banks in favor of a focus on the largest institutions. Another proposal would transfer all bank supervisory powers to a separate single bank regulator. Yet taking away the Fed's supervisory role on Main Street and on Wall Street would be unwise. As the central bank, the Fed has the depth of experience and expertise to monitor banks of all sizes. But more importantly, these responsibilities support and complement the central bank's ability to meet its congressional mandates for financial stability and monetary policy. In 1997, the United Kingdom took bank regulation from the Bank of England and gave it to the Financial Services Authority. Based on their experience during the crisis with a separate regulator during this crisis, the UK government is now considering moving regulatory activity back to the central bank, exactly the opposite of what's being considered in the U.S. Chairman Bernanke submitted a report to Congress that clearly outlines the sound reasons for retaining supervision at the Federal Reserve. The current crisis underscores the importance of having a regulatory framework that addresses both safety and soundness of individual institutions, but perhaps just as important, if not more important, is address the macro-prudential risks of the financial system as a whole. Given the Fed's traditional central banking roles, including having lender of last resort responsibilities, overseeing the stability of the financial and payment systems, and setting monetary policy, it is uniquely equipped within the government to undertake these responsibilities. In my view, the proposals for regulatory reshuffling at best miss the point of what's required for meaningful reform, and at worst, weaken the current regulatory framework. The real danger is that such such proposals will increase the likelihood of a future crises rather than fixing any real problem. Instead of elaborate restructuring, I suggest we focus on 3 key initiatives that I believe will truly improve our financial regulatory system. Of course, I should note that these are my views, not necessarily views of the system, and you shouldn't attribute them to Eric either. First and foremost, I believe Congress should amend the Bankruptcy Code to include a new chapter for large non-bank financial institutions. In my view, the most important issue of reform must address the too-big-to-fail problem. Without a credible resolution mechanism to allow orderly failure of large and interconnected financial firms, we will be setting the stage for the next crisis. Thus, foremost on the agenda should be the recognition, in my view, that no firm should be too big to fail. Any resolution mechanism should address systemic risks without requiring taxpayer support. To foster market discipline and reduce moral hazard, the resolution mechanism must ensure that a failed firm's shareholders are wiped out and that creditors bear losses. Most important, the resolution mechanism must be credible. Managers, owners, and creditors must believe that firms on the verge of failure will in fact be allowed to fail. Therefore, we must limit regulatory discretion or forbearance and the probability or potential for political interference. The resolution mechanism must not become a mechanism for more bailouts. I am concerned that the current legislative proposals allow far too much discretion and could lead to more bailouts, not fewer. Now, given that requirement, I believe that a modified bankruptcy process would be a better mechanism than proposals to expand the bank resolution process under FDICIA to cover non-bank financial firms and bank holding companies. It seems far too easy in the heat of crisis to deem that systemic risks are too high to let an institution fail. Yet, as we have seen, when firms expect to be protected from failure, they take greater risks, usually at taxpayer expense, and in doing so, sow the seeds of another crisis. No doubt lawmakers will need to work out the details of a new bankruptcy chapter, including who would force an institution into bankruptcy. I would favor not only the regulator have that power, but also creditors to place a troubled financial institution into bankruptcy when it's unable to meet its obligations. This would enhance market discipline and lower regulatory discretion. Another issue involves how to handle qualified financial contracts, including swaps, repos, derivatives of those firms that are in bankruptcy. Current law exempts these contracts from various provisions in the bankruptcy code, including the automatic stay provisions. In other words, the contracts are permitted to close out even though the firm is in bankruptcy. Some argue that these exemptions prevent systemic risk. Yet others argue that these exemptions actually raise systemic risks in the events surrounding Bear Stearns, AIG, and Lehman Brothers. Another important dimension to this theme of this conference is that the international nature of these large firms means that we must also work to ensure an international coordination of this bankruptcy process. It's not uncommon for international firms to fail and be resolved around the world. We'll also need to ensure a timely bankruptcy process so that the bankruptcy proceedings do not drag out for years. I don't think any of these challenges are insurmountable. Moreover, I'm not arguing to replace the current process of resolving small bank and medium-sized bank failures outside of bankruptcy. The FDIC has demonstrated its ability to resolve these institutions reasonably quickly and at relatively low cost to the taxpayer. However, the handling of the largest financial institutions during this crisis has persuaded me that that system cannot easily be expanded to encompass large firms without biasing those outcomes towards bailouts rather than resolution. Thus, I favor a bankruptcy mechanism as a more credible solution to the too big to fail problem. My second recommended action is to clarify the Federal Reserve's umbrella supervisory role for financial holding companies. Under current legislation, the Federal Reserve supervises bank holding companies and serves as an umbrella supervisor for financial holding companies, while appropriate functional regulators supervise the subsidiaries. For example, the SEC supervises an investment banking subsidiary, while a state insurance commission supervises an insurance subsidiary, and the designated federal state bank supervisor watches over the commercial banking subsidiary. Now, to reduce regulatory burdens, the Gramm-Leach-Bliley Act limits the Federal Reserve's powers to examine these subsidiaries, which already have a functional regulator. So the Fed has relied on these functional regulators for information about holding company and its subsidiaries. I believe Congress should clarify that the Fed has umbrella supervisory powers and the responsibility to exercise them, including collecting supervisory information and information independently on the holding company and all of its subsidiaries on a routine basis. These changes would not broaden the supervisory powers of the Fed or necessarily any other agency. Indeed, under Gramm-Leach-Bliley, the Fed has been given authority to examine and take actions against any subsidiary that may pose a material risk to the financial safety and soundness of the insured depository institution, whether it be domestic or international payment systems. Clarifying the Fed's umbrella supervisory role would encourage regulators to work together and take a comprehensive look at the systemic risk of these consolidated financial organizations, not just the bank. This thorough review of each firm would help the Fed in its macroprudential mission and help ensure that financial stability and the integrity of the payment system is maintained. Further, I believe that Congress should clarify the Fed's financial oversight responsibilities by requiring the Fed to deliver a semi-annual financial stability report to Congress and to the public, much as it requires the Fed to submit a monetary policy report. I believe such a report would improve the transparency and accountability of the Fed's financial oversight responsibilities, and which would help ensure public trust and our own credibility. My third recommendation is to integrate market discipline more effectively into our regulatory structure rather than solely relying on rules. Consider financial institution capital regulation. One of the lessons of the financial crisis is the speed with which capital ratios can decline. A firm can move from well-capitalized to undercapitalized almost overnight, and then face enormous difficulties in raising capital in the midst of a crisis. This argues in favor of raising regulatory capital ratios for financial institutions. Yet rather than simply raising capital requirements, regulators should marshal market forces by requiring financial firms to hold contingent capital in the form of convertible debt that would convert to equity in periods of financial stress. Contingent capital would be less costly than simply raising capital requirements, since it's triggered only under bad economic conditions when capital is in fact most costly. Thus, it reduces the incentive for financial firms to seek ways to evade dramatically higher capital requirements. The ready contingent capital also avoids the need for fire sales of assets to raise capital, which can exacerbate an economic downturn. And perhaps most importantly, it can reduce the necessity of government rescues and bailouts. Contingent capital would enhance both regulatory supervision and market discipline. The market price of such debt would provide regulators with a valuable signal about the financial health of a firm and about the market's perception of systemic risk. In addition, the threat of the debt's conversion to equity would mobilize creditor discipline. We should also consider requiring higher levels of capital for banks that pose greater systemic risk. This might be done by basing capital requirements not only on credit risk, but on liquidity risk and potentially asset growth. These steps would strengthen market discipline and improve financial stability, and regulators can do much of this without additional legislation. I believe these three actions would go a long way towards improving financial stability: enacting a credible bankruptcy process to solve the too-big-to-fail problem, clarifying the Fed's umbrella supervision and financial stability roles, and enhancing market discipline are steps we must take to lower the probability of a future crisis. We could simplify the entire regulatory legislative initiative by focusing on these three elements. We do not need new bureaucracies or a complete restructuring of our regulatory agencies. These, of course, are just a few of my own thoughts on post-crisis reform, but today we're going to have the opportunity to hear many more ideas and many more thoughts on how to progress towards a sound solution that will safeguard the integrity of our market-based system. I look forward to these presentations and the discussion that will follow. Thank you very much.